Welcome back to the deep dive. We know you want those key financial insights without having to sift through pages and pages of filings.
Definitely. Too much noise out there.
Exactly. So today we're diving into the specialty grocery scene. We're focusing on Sprouts Farmers Market, that's ticker SFM.
Sprouts, yeah. They've been making some waves.
Right. And our goal here is to really cut through their latest numbers, the Q3 2025 results. We want to, understand their business model, what makes it tick.
And the risks, too. What keeps their management team awake.
Definitely the risks. And then critically, how does it stack up against some classic valuation measures? Does the growth story actually hold water?
And we really need to kick off with the numbers that got our attention in the first place. Sprouts isn't just doing okay. They seem to be, well, accelerating.
Accelerating is a good word for it. That Q3 snapshot, it's pretty compelling.
It really is. Net sales hit $2.2 billion. That's up 13% from last year. 13%.
Wow. Okay. 13% is a serious jump year over year. But the number that really caught my eye, comparable store sales.
Ah, yes, the comps. Always crucial in retail.
They grew 5.9%. In the grocery world, which is just brutally competitive, getting almost 6% comp growth, that means you're taking share, right?
Absolutely.
Yeah.
It means customers are consistently choosing them, coming back, spending more. It's not just new stores driving the growth.
And that flowed through to the bottom line too, didn't it?
It did, quite nicely. Diluted earnings per share landed at $1.22. Compared to 91 cents the year before. So a really significant jump in profitability.
Okay, so what does that tell us? Strong demand, obviously, but maybe something about efficiency too.
Yeah, I think it points to both. Continued consumer appeal for their offering, and maybe some operational leverage kicking in as those sales numbers climb higher. They're getting more profit out of each dollar sales increase.
All right, let's unpack the engine behind this. The business model itself. Sprouts has what, about 464 stores now?
Around that, yeah. Across 24 states.
And their whole identity is built around being a specialty retailer, right? Not trying to be everything to everyone.
Yeah, exactly. Focus purely on fresh, natural, organic foods. It's a specific niche.
So how does that niche show up in what they actually sell? What's the breakdown?
Okay, this is really key to understanding them. The revenue mix, 57%. Almost 60% of their sales come from perishables.
57% perishables. Wow. So produce, meat, dairy, bakery, that kind of stuff.
Exactly. The fresh stuff. The other 43% is non-perishables, packaged goods, vitamins, supplements, things like that.
The 57% number, that feels really high compared to a traditional supermarket.
It is. It's core to their brand, that fresh market feel, the whole open-air, farm stand kind of vibe they go for.
I get the appeal for the customer, but operationally, handling that much fresh product must be tricky.
Oh, it's incredibly complex and risky.
Yeah.
High perishables means you have to turn inventory fast. Your logistics need to be super precise.
And waste. Shrinkage must be a constant battle.
A huge battle. Way higher potential for waste compared to a store selling mostly canned goods and cereal boxes. It makes their cost of goods sold very sensitive to sourcing, supply chains, food prices.
It sounds like a high wire act. They seem to be managing it based on the results, but the risk is baked in.
Absolutely baked in.
So that fresh focus, the store ambiance, that's their main differentiator, their competitive moat, so to speak.
That's a big part of it. Plus, they're private label brands, and they often try to position their organic offerings as slightly more affordable than, say, Whole Foods.
Yeah.
Trying to hit that value-conscious health shopper.
But how strong is that moat, really? You mentioned the brutal competition earlier.
Yeah, we have to be realistic here. The moat is, let's say, modest. It's not insurmountable. They are squeezed from multiple angles.
Okay, tell me more about that squeeze. Who are the main threats, and how are they attacking Sprouts' niche?
Well, you've got the traditional giants, obviously Kroger, Albertsons. They're not standing still.
Right, they're all expanding their own organic lines.
Aggressively. They're launching their own natural and organic private label brands, directly competing on price and convenience, trying to neutralize that lower-priced organics angle Sprouts might have.
Okay, so the big guys are moving in. What about others?
Then you have the real disruptors. Think Walmart on price, Amazon on convenience.
Amazon with Whole Foods and their delivery network.
Exactly. 2-hour delivery for fresh groceries. That's hard to beat on convenience. And then you have the discounters, like Aldi.
Aldi's expanding rapidly too, right? And getting more sophisticated in their offerings.
Very much so. Aldi attacks with extreme operational efficiency, keeping prices super low. They're also adding more specialized products. So Sprouts is getting pressured on price by Walmart and Aldi, and on convenience by Amazon and the big guys.
So their main defense is really that unique in-store experience.
Largely, yes. because the actual cost of, say, a pint of organic blueberries isn't wildly different supplier to supplier. It comes down to the shopping environment and brand perception. If that experience falters, or if someone else matches it and beats them on price or convenience,
that edge could disappear pretty quickly.
Okay,
that leads us straight into the risks. Beyond just general competition, what are the more immediate pressures?
well, the sort of cyclical stuff every retailer is facing now. Shifting consumer spending, people getting squeezed, maybe trading down.
And inflation, especially food inflation?
Huge. Food price volatility is a major headache for them. If their input costs for produce or meat jump, it's hard to pass all of that onto their shoppers, who are often value sensitive within that organic space. It squeezes their already thin margins.
Makes sense. What about risks more specific to Sprouts' own operations? You mentioned supplier concentration earlier.
Yeah, that's a big one. Supply chain risk. The source material highlights that one main supplier, a company called Key,
Okay.
they apparently supply something like 47% of Sprouts' total purchases. Nearly half.
47% from a single supplier. Wow.
Yeah. Now that probably gives Sprouts good negotiating leverage and simplifies logistics in some ways. But the flip side
Is massive dependency. If anything happens to Kihi, a strike, a warehouse fire, financial trouble, that's a huge disruption.
instantly impacts nearly half their product flow.
Mm-hmm.
That's a significant concentration risk for sure.
Okay, 47%. That's a number to watch. Let's flip from risk to cost structure. Grocery margins are notoriously thin. Managing that cost of goods sold, the COGS must be everything.
It's the absolute core of the P&L, and like we discussed with that high perishable mix, their COGS is naturally pretty high,
What was the number again for Q3?
around 61% of sales. So 61 cents of every dollar that comes in the door goes right back out just to pay for the products on the shelves.
And given the fresh food focus, that 61% is probably pretty sticky, right?
Yeah.
Hard to squeeze down dramatically.
Very hard. The nature of sourcing fresh, quality produce, meat, dairy, it costs what it costs. There's only so much efficiency you can wring out there.
So that's the variable cost picture. What about fixed costs? You mentioned something interesting about their balance sheet and real estate earlier. Low debt, but
Right. On paper, their traditional debt looks very low, which is great, but they use operating leases for almost all their stores.
okay, leasing versus owning. Pretty common in retail.
It is, but you have to look at the total commitment. Those long-term lease obligations add up. The analysis pegged it at roughly $1.52 billion.
$1.52 billion in lease commitments. How does that compare to, say, the value of the company itself?
Well, that's what makes it significant. That $1.52 billion is actually higher than their total shareholders' equity, which was around $1.32 billion.
Higher than equity. Okay, explain why that matters so much.
It acts like hidden leverage. It's a massive fixed cost. Whether sales are booming or slumping, those rent checks are due every month. It makes the business model very sensitive to sales volume, especially that comp store sales growth we talked about.
So if comps slow down or if they open new stores that don't perform well?
That lease burden becomes a major drag. It reduces their flexibility. They can't easily just cut costs the way a company with fewer fixed commitments could. Sustained growth is almost essential to cover those fixed costs comfortably.
Which puts immense pressure on management to execute flawlessly.
Absolutely paramount.
And based on the recent results, that 13% revenue jump, the nearly 6% comps, it seems like the current team is executing pretty well. Jack Sinclair's been CEO since 2019, right?
Yeah, and the track record under his leadership seems solid. They've hit targets, like crossing $7.7 billion in revenue for fiscal 2024.
And the store expansion seems disciplined?
It does. They're consistently opening around 30, maybe a few more, new stores per year. And importantly, they seem to be focusing on a smaller store format now, which might be more efficient and easier to cite. It's just they're learning and adapting.
And is management's interest aligned with shareholders? You often see big stock grants.
Definitely seems to be significant alignment here. The CEO, Sinclair, reportedly got substantial stock awards, something like $42 million worth in 2024 alone.
Wow, okay.
When a large chunk of executive pay is in stock, they're incentivized to do things that boost the long-term share price.
Which often includes things like share buybacks.
Exactly, and Sprouts has been very aggressive on that front.
How aggressive?
They recently expanded their share repurchase authorization up to a huge $1 billion.
$1 billion for buybacks.
$1 billion. And they're actively using it. In Q3 alone, they bought back $50 million worth of shares.
Okay, so they clearly think the stock is a good use of capital. The question is always, are they buying back at good prices or just try to prop up EPS?
That's the perennial debate with buybacks. But the sheer scale and consistency here does show a strong commitment to returning capital to shareholders and reducing the share count over time.
Yeah.
It definitely helps EPS growth.
All right, this brings us to the crux of it, the valuation tension. We have this company performing well, growing fast, generating cash, but in a tough industry with high fixed costs. So when you apply a really strict disciplined value lens, like a Buffett-style checklist, what happens? Is Sprouts a bargain?
And this is where it gets really interesting and, frankly, contradictory. By strict, classic value investing standards, no, Sprouts is not a bargain.
It fails the tests. Which ones?
Several key ones. First, just basic valuation multiples. A classic value investor wants cheap. Sprouts' price-to-earnings ratio is up there, around 26x.
26 times earnings. For a grocery store, that sounds high.
It is quite high for the sector. And price-to-book is also elevated, around 8x. These are multiples you might associate more with the growth tech company, not a retailer selling organic kale.
Okay, so it fails on cheapness.
Yeah.
What about profitability or safety margins?
Right, second failure. Net profit margin, it's around 5%. Now, for a grocer, 5% isn't terrible. It's actually decent. But
A truly high-quality, durable business, the kind value investors love, usually has much higher margins, like 20% plus.
exactly. That 5% margin doesn't leave a lot of room for error if competition intensifies or costs rise unexpectedly. And third, on a more technical safety point, the current ratio measuring short-term assets versus liabilities is only about 1.0.
And value investors usually want to see that above, what, 1.5 for a cushion?
Yeah, 1.5 or even 2.0 sometimes, just for that extra safety margin. So 1.0 is pretty tight.
Okay, so fails on PE, fails on PB, fails on net margin, fails on current ratio. Not looking like a classic value play.
Not by those strict metrics, no.
But you said it's contradictory. Where does it pass? Where does it look attractive from a quality perspective?
It shines brightly on other crucial aspects, particularly financial health and profitability generation. The balance sheet management is stellar, looking beyond the leases for a moment.
How so?
Actual debt to equity is incredibly low, like 0.06, practically no traditional debt.
0.06. Okay, that's tiny.
And their interest coverage is fantastic, so strong, in fact, that in 2024 they actually reported net interest income.
Wait, income? They earned more interest than they paid out.
Yes, they were making more money on their cash balances than they were spending to service the tiny amount of debt they have. That's a huge sign of financial strength and cash generation.
Okay, that's impressive. What about profitability metrics?
Really strong there, too. Return on equity, ROE, is very high, around 29% on a trailing 12-month basis.
29% ROE, that's generating serious profit relative to shareholder investment.
It is. And free cash flow, FCF, the cash left over after running the business and investing, is also strong and, importantly, growing. It hit $415 million in 2024.
Right, so we have this picture. Fails the cheap tests, but passes the quality tests, like low debt, high ROE, strong FCF, which leads us to the discounted cash flow, the DCF analysis. That model looks at future cash flows, right?
Exactly. It tries to value the company based on the present value of all the cash it's expected to generate in the future, and given Sprouts' strong FCF growth.
The results were pretty eye-popping, I gather.
They were. They stand in stark contrast to those PE and margin concerns. The DCF model, if you believe its growth assumptions, paints a very different picture.
Okay, walk us through it. What did the model suggest for intrinsic value?
Well, even a relatively conservative case. Let's say assuming FCF keeps compounding at a strong, but perhaps not insane, 26% per year for a number of years before slowing down.
26% growth.
Yeah.
Okay, what value did that produce?
That model yielded an intrinsic value of around $186 per share.
$186. And the stock today is trading around, what, $100?
Roughly, yeah. So that conservative DCF suggests significant undervaluation.
Okay. And was there a more optimistic case?
Oh, yes. The nominal case, which used growth rates closer to some of their really high historical averages, we're talking SEF growth assumptions, maybe closer to 55% annually for a period.
55%. Okay, what did that spit out?
That pushed the estimated intrinsic value up towards, well, almost $500 per share, like $499.
$499 per share. That seems incredibly high, almost too good to be true.
That's the immediate reaction, right?
Yeah.
And it highlights the massive caveat here.
Which is?
These DCF results are extremely sensitive to those future growth assumptions. To get values like $186, let alone $499, you have to believe Sprouts can maintain very high rates of free cash flow growth for a long time.
And sustaining 26% or even 55% FCF growth year after year in a mature, competitive market like groceries. That seems like a very big if.
It's a huge if. As the company gets bigger, as they saturate the easiest markets for expansion, maintaining that kind of growth velocity gets harder and harder. Competition doesn't sleep. Those high DCF values are mathematically possible if the growth continues at that pace. But you have to ask yourself how realistic that if truly is long-term.
Right, so that really frames the core takeaway here, doesn't it?
Right.
Sprouts Farmers Market is this fascinating contradiction.
It really is.
You've got these fantastic quality signs, stellar ROE, almost no debt, gushing free cash flow. But at the same time, it fails those classic value tests. It trades at a premium PE. Margins are okay, but not great. Liquidity is tight.
The market is clearly pricing in a lot of future growth, betting that the quality metrics will keep driving results higher.
So for you listening, the question becomes, how much faith do you put in that growth story, continuing at such a high pace? You have to weigh that against the very real structural challenges.
The intense competition from literally everyone.
Walmart, Kroger, Amazon, Aldi, all pushing into their space. And that huge $1.52 billion fixed lease obligation hanging over them.
Right. Can they really keep expanding FCF aggressively enough, keep that amazing 29% ROE going strong year after year to justify the current price, let alone those huge DCF numbers?
That tension between the proven execution and quality on one side and the competitive reality and fixed cost structure on the other, that's what makes Sprouts such a compelling company to analyze right now. It's definitely one to watch.
Okay, before we wrap up, just a couple of quick notes. If you're interested in tracking overall market sentiment, you might want to check out the Buffett Indicator app. You can search for it on the Apple App Store to get daily updates.
And as always, a quick disclaimer. All the analysis we've discussed today is based on publicly available information and our interpretation of it. It's purely for educational purposes.
Absolutely. This is not investment advice. Please do your own homework, your own due diligence before making any investment decisions.
And if you enjoyed this deep dive and want more in-depth analysis, consider joining our Deep Value Club membership.
Or you can subscribe to Deep Value Investing on Apple Podcasts or Spotify. Thanks for tuning in.